Good morning. Welcome Beyond the SEAF model. I'm Jack Kosar. This is effective for the week of May 11th, 2026. Let's get started. SEAF signals for this week. We retain technology and materials, and we pick up industrials. Really seeing that massive strength here from that technology coming with ones across the board with overall ranking of 3. Materials coming in at 2 at 9 with a decent score. And then industrials kind of coming back with that nice positive skew 6 to 4 to 2 with their overall ranking of 12. We see energy fall off the board here. Pretty steep outflow. It actually kind of trickled into the tactical month overall, being held up by its strategic quarter. And healthcare rounding out the bottom here, even with a score of 8. Heading into our heat map, key thing here is the money still continues just to run the technology. Outside of technology, we had 1.61% on the trading week, so that's pretty significant number here in terms of asset flows. Just picking up some really strong accumulation through the tactical month and the strategic quarter. This is very dark green and would be no matter what the case was. Everything else is relatively light. Coming in at number 2.14 on the trading week. That's pretty light. Relative even to the 1.61, but still. Light flows kind of all the way through here. Seeing the outflows were a little bit stronger this week. Energy negative 0.52 outflow, and then utilities negative 0.37. The key thing with energy is, pretty much directly related to the interventions and things going on in the Middle East, the war in Iran. So, as news updates and changes on, ceasefire, no ceasefire, straits closed, straits open, this thing's going to be very volatile. We mentioned that earlier in the year when we were highlighting, energy as it was kind of raising up with the fact that a lot of this had to do with the war and that, pay attention to that standard deviation. It was extremely high. I think it was upwards at one point of 70%, meaning the daily changes in returns were extremely aggressive. And it was kind of a place, place you could make money, but, place you could get burned to. And, we had a big quick reversal here on energy coming in from last week. Thing I wanted to kind of highlight here, before I do that, 3 of 5 were up days last week. We're hitting fresh all-time highs in the assets under management. Now it's north of 72 billion, or 372 billion. So, clearly nice above that 21-day moving average. Caught good chunk of this move if you're using this as a risk on, risk off signal. Again, we never recommend just one indicator. They don't always work well, but this one's been doing pretty well lately. This is the total AUM of the 11 sector spiders plotted on a graph. And then down here is the price chart of SPY. As you can see here, anything above that 21-day moving average, we got room to either move up or in the case running up to here, at least stay sideways, a collapse below the 21-day moving average price depreciation in the S&P 500. But the broader point that I wanted to make, and I wanted to note, we're pulling this from the source of the State Street website, ssga.com. In the last month, the only sector that is outperforming the S&P 500 is XLK. Coming close is consumer discretionary, but 9.14% over the last month for the S&P 500, 23.88 in technology. So, this really kind of works in what we're seeing on the heat map. Money flowing aggressively into technology, and then everything else kind of middling. The SEAF model is going to continue to rotate those bottom two, obviously as long as flows continue into technology, but rotate that bottom two, the two other signals into where the money is flowing the strongest next in hopes of catching that next move. What we're going to highlight in a second here is just because you're in the top 3 doesn't necessarily mean that you are relatively outperforming. And in this last month, you couldn't be because only technology was. But we're going to highlight, here's materials. Materials is spending some time in that middle favorite area, has been for a little bit. We are currently underperforming the S&P 500. Does that mean you're necessarily losing money? No, it just means that, as of right now, the big play and where all the money is going, and again, I'm going to bring it up just for emphasis, all of that money is flowing into technology. This is kind of, AI and the idea that a lot of these AI companies came in with strong revenue gains, and that AI is starting to, change items on the balance sheet and some of the revenue totals, this is the really driver of the broader economy right now. Everything else is either middling or losing assets, but the money is strongly flowing in technology and it's keeping us afloat. And because technology is such a large part of the S&P 500 on a cap weight adjusted basis, it's able to kind of keep up the entire market. So nothing wrong with materials here, sitting in that middle favored, but just underperforming what has been a rocket shot out of tech and the market as a whole. Industrials, kind of a similar boat. We've been kind of floating in and out of this middle to lower favored over the last month or so, declining on the relative performance versus SPY, but it's where the money's going on a relative basis, right? Industrials 2 on the trading week, 4-6 positive skew. Does that inherently mean that we're going to go up from here on the relative performance side? Not necessarily, but again, it is tough to keep pace with what has been a lightning hot technology, XLK. Speaking of the lightning hot XLK, I actually have to keep adjusting my left-hand parameters because we keep trying to, the relative performance chart keeps trying to creep up into my rainbows. So I have to keep slightly adjusting this to just kind of keep pace with this. But this is a very strong upward relative outperformance move on the S&P 5 versus the S&P 500. Tech, obviously, bring back our tech is greatly outperforming the broader market over the last month, and it's just been a really strong place to be, sitting up in that upper favorite and kind of holding it. Really nice, strong run up, especially for technology. It's been a really good place to be for us in general. Lastly, I have healthcare. Healthcare is sitting at the bottom, underperforming the market pretty strongly, sitting in that avoid and overall downtrend in the broader market. Now we are starting to see a little bit of an uptrend, that 11, 10, 8. So, but it's still pretty strong outflows here, even with a negative 0.29%. So money's still flowing out of healthcare. Nothing to do here yet, or even soon. We are still sitting in that deep avoid. So, but overall healthcare leading. So I guess the big takeaway here is tech is leading the market and it is dragging everything else along with it. And it's your greatest source of relative outperformance. And the SEAF model has gotten us there, and we've been there for a couple of weeks now. That is all I have for this week. I look forward to breaking down the SEAF model with you all next week, and thank you.